I'm not your typical accountant. Just want to throw that out there. Some of the things I'm saying are not the views of HA&W. No, I'm definitely, I love accounting. I've grown up as an auditor at PwC in Amsterdam, actually. I'm a Dutch national. And I worked there for about 5 years, and then something funny came through email which said, hey, we're implementing Sarbanes-Oxley and we don't know if we got enough people to help with it. So anyone can apply to come to the US and work on that. So I raised my hand. Atlanta ended up calling me because of Randstad, which was my client in Amsterdam, and they've got a significant presence here. And then I worked on that when I came here and on Eastman Chemical. Eastman Chemical was one of my SOX, Sarbanes-Oxley clients. And then just continued in an audit role, but the last 7 years have been in accounting advisory, both with PwC, and I've been with HA&W now for 2 years. And it's different because essentially I'm doing the same work as I did at PwC, but now in a non-Big Four capacity. And I've actually found out and sort of discovered that some of my clients actually specifically ask for a non-Big Four accounting firm for a multitude of reasons. So I'll just continue on with what I've been doing, and I'm doing it under the HA&W brand. It's been great. And I'm happy to be here and talk to you about this. It was sort of on the fly, but I talk about this particular topic a lot, and I know not everyone here is an accounting specialist or focused on financial reporting, but this particular standard deals with revenue recognition. And therefore, we're all impacted because we're either compensated based on revenues, or we talk to investor relations related parties, analysts, lenders, investors that are interested in the revenues of your company. This standard is therefore very pervasive. It impacts the recognition of your revenue, which period you should be recognizing. It basically regulates how much revenue you can recognize depending on how much you think you can collect. And it impacts all industries. It's not just software companies. It's not just carpet companies or manufacturers in general. It's everyone. Everyone's in scope that applies either US GAAP or IFRS. So it's also a global standard. I can put some music and then we'll go dancing. It's another option. But I think the key is the global standard, which is kind of cool in my experience. You see that I can talk about this here, but I can talk about this in the Netherlands, in the UK, in Germany, or even in Asia, or in South America, language, sort of put aside. But it's applicable everywhere where they apply either IFRS or US GAAP. So I think those are always interesting developments, because now you've got one company in the US, I'll mention Ford Motor Company, applying the same standard as Volkswagen in Germany, right? And they're under IFRS versus US GAAP. And so the interpretations, and this is the cool part in my opinion, is culture, how culture impacts the interpretation of accounting standards. You got two of the same companies, very similar, have a history together, sort of market the same way, have similar client base, but because the one is in Germany and the other is in the US, I'm sure they talk to each other and figure out, hey, how are you going to do this? But there may be some differences, because historically Volkswagen was a German GAAP company, and German GAAP is very tax driven and very strict. And US GAAP is more focused on, hey, let's make sure we give our investors all the information needed. So it's good to see that. It's good to see sort of convergence. As you might remember, the SEC in 2008, and this was under Chairman Cox, basically said, hey, let's get rid of US GAAP and let's apply IFRS on a mandatory basis. And of course, then the financial crisis happened, and the SEC basically let it sit there, put it on the shelf. Then, most recently actually, and you can Google this, that same chairman is now obviously retired, basically said that was a bad idea, okay? He said it was a bad idea because he didn't believe that, the ISB that issues those international standards, IFRS, was basically up to the task and was relying, was it basically, could they really rely on such a standard issuer? It's a political game, really, at the end of the day. But even though we're not really doing a wholesale adoption of IFRS, which was proposed, but it's shelved, we're still doing this. And what this is again, it's marketing. It's going to be US GAAP, but essentially what we're doing is we're moving from our very rules-driven, elaborate, detailed US GAAP guidance on revenue recognition, where if you're a software company, technology company, you're bound to have a specialist on revenue recognition on your staff. Why? Because it's 200 pieces of literature, it's thousands of pages to get through, and you either are or you aren't a RevRec specialist in those particular industries. Well, guess what? We're moving to an IFRS model, which is principle-based, no longer industry-specific. There's no more software standard, okay? We're applying the same guidance. So a Mohawk Industries, making carpets and flooring products, applies the same standard with the same language as a Infor, for example, right? Software. And that's sort of new to us, especially in the US. And I see struggling companies, right? Because they're like, well, I had something very specific, and everybody's looking for examples. It's like, how do I do this? How do I do that? And so what's interesting about this standard is companies are actually sort of more inclined to talk to each other and say, hey, why don't we just get together as a group? And then we talk about how we view the principle, and I'll show you what that looks like. And then we'll have some consensus in the industry. And then you could choose to share that with the FASB and say, hey, what do you guys think? Did we interpret this right, or is it wrong? And we're doing that with the software companies. HA&W has a lot of software clients, and every quarter we get together, have breakfast in our office, and we talk about these particular topics. So if you're interested, let me know. Make sure you're on the mailing list. The other thing, if you're not a software company, any company can get 2 hours of free CPE at their office, hosted by us, completely tailored slide deck that basically goes into the company-specific transactions. You get 2 credits of CPE, and it's a good, nice way to start talking about this, because it's coming, and you can't really, it's not optional. You have to apply it. Any questions so far?
You may be heading towards this anyway. What is difficult about revenue recognition, let's say in software business?
Just in general?
Yeah, what are the real difficulties? Because there must be a number of different ways of recognizing revenue.
Well, I think one backdrop might be interesting is WorldCom, as an example, right? Health South be another one, different industry. Booking up fixed assets, debit, crediting revenue. It's obviously prone to fraud. It's the most important line item in your financial statements. So that's one, right?
You can mark up your fixed assets, you can balance that all by recognizing revenue and cheating.
You go to jail like Scrooge did, right? I mean, yeah. But companies, they're always sort of, especially when they're public, right? They sort of are enticed to make the numbers, and revenue being the most important one. But that backdrop, I think if you go back in time, software companies, they make a lot of new applications, new products. Contracts are more complicated. Hey, I'm not just offering you software, but I'm offering you upgrades. I'm offering you training, post-contract support, you name it, installation. You can get a license on-premise, or you do it as a subscription service. There's all kinds of possibilities, right? And so a contract is very difficult already, and then it's difficult to say, well, what did you offer? And when do you recognize all these different offerings? Because it's not just one software, it's not one deliverable, it's multiple deliverables. And so the FASB has started to write specific interpretations and rules to account for those type of contracts. Construction companies, same thing. I mean, we had two models essentially. It's completed contract if you don't know what your profit's going to be until the project's done, or you do percentage of completion if you continue to just build apartment homes and it's all the same standard process and you know what your profit's going to be, then you can recognize over time as you develop the project. Specific rules, complicated, very important line item. That's why it's obviously an important standard, and it has actually really generated a lot of guidance. And it's interesting to see. I mean, with this new standard, we basically are sort of forgetting what we had before. And a lot of words we know are no longer in the new standard. And I'll tell you why that is. So, basically, this sort of summarizes what I just told you, but I think what the takeaway on this one is, I think you need to think about how long it takes for the boards to come out with an accounting standard. And to make you feel better, perhaps, it's because they're really incorporating users' opinions and preparers. So they'll go out and talk to investors, or they're going to talk to companies and say, hey, can you guys really implement this the way we think it should be implemented? And then they go back to the drawing board. So this project started in 2002, okay? So that's what, 13 years ago. It's a long time. I followed it since 2008, and it got frustrating because obviously I'm trying to make money with it. And they kept on, redoing the standard. And even as late as this month, July, they just decided to give everybody an extra year to implement it. So now we're finally in a position where we say we know when it's applicable, we can start planning for it. And that's why it's relevant.
So what is the date of implementation?
I'll get to that. And when you see that, you'll say, why am I here? Why are you wasting my time? But I'll get into why. I'll get into why it's relevant now. So I think I covered most of these. I think maybe one thing that's interesting is when you look at what you buy today as a consumer, everybody's got a smartphone, everybody has a vehicle. Well, a car is almost like software on wheels now, right? So it becomes a different type of product. A phone, I remember the ones where you'd have to like dial like this, right? I mean, I'm not even that old, but that's how fast things go in development. And now I can do everything with my phone, right? So it became a device, and the software is so much more important for its functionality. So we had this software standard, and this is where old gap basically fills. So a company like Apple, which I read the other day, it has, I think, looked at the Fortune 500 list, and I think Apple is the #2 company with the most profit globally, by the way. So I was sort of shocked because it was right behind either GE or ExxonMobil or something. But in any case, we're all about software and data and connectivity and you name it. So what they did under the old rules, and this goes back a few years, when an Apple iPhone got issued, say in the fall, everybody started buying it for the holidays, and it was all sort of transactions before the end of the year. But Apple had to wait with recognizing the revenue, at least a large portion of it, until everything was delivered, which was going to happen the next year, which includes the software, the apps, and the functionality of it. So Apple basically pushed the FASB and said, that doesn't make any sense. I want to show when I actually sign a customer buys the actual device, I want to recognize as is. So the FASB already started modifying the guidance even before this happened with the global convergence with IFRS to allow Apple to recognize earlier. To allow Apple to recognize earlier because they didn't have fair value for everything that the iPhone contains. Under the old rules, it says if you don't have fair value for everything you deliver, which is multiple elements, you got to wait until everything is delivered, right? And that could take, it could be multiple years. You think about a telco, when they sell you the device and the service, the contract, to defer that revenue is obviously not something companies generally like. However, when you only pay $100 for an iPhone, but the thing's really worth $500, what should the company recognize? So that was another issue. The telcos have had an out. They said, I'm only recognizing the $100. Whatever I got paid, they call it the contingent cash cap. Even though I sold you something that's worth $500, I'm only recognizing $100 because that's what I got paid. Even the telco said, boards, I don't want you to change that. I like it, it's conservative. The board said, nope, you're just like anybody else. You got to recognize the fair value. You sold a phone that's worth $500. I need you to show that in your financial statements. So that's sort of the backdrop to this. It's like, make sure you reflect the economics of the transaction.
Why could they not show that the price of $100 they got for the sale, and then the 20 some odd dollars they got each month as an additional essentially loan or some other continuing revenue? Why couldn't they book it that way?
Well, because what's technically happening is I'm selling you the phone for $100, but I do that because you're signing up for a 2-year agreement, right? That's the economics of the transaction. But in essence, I have some level of certainty that you're going to continue to pay me on a month-to-month basis for the next 2 years, right? So what the board is saying is, look, you've actually already incurred some of that revenue, more than the $100, because you basically sold the phone for less at a discount because you're getting the contract. So in the old rules, it says just $100. The new rule says this: $500 for the phone, $240 for whatever the contract. You add those together, yeah, right? And you say, what's the total value of the contract, including the phone that I'm charging? And I'm doing a relative allocation between the phone and the contract.
For cost accounting purposes, can I split them up or put them as the cost that I'm getting for the cash I'm getting for the phone and the value of the contract?
It's one contract.
I can't split it?
Nope. No, because the transaction's really one. That device is needed to get the 2-year contract to be able to make the phone calls. So it looks at it and say, well, that should be combined, but you got 2 deliverables. So.
So does it make the revenue, it sounds like it would make the revenue recognition twitchier, because if you get a contract and you don't get a contract, it pulls
Yeah.
forward, it's less conservative. So are we going to see more volatility in revenue recognition?
Yes, absolutely, more volatility, but also more revenue recognized earlier. I mean, for baseball fans or any sports fans for that matter, the best analogy is like when a player signs a contract, they'll get a base pay and they'll have performance related pays. Now, from the player's perspective, did he sign a contract for $10 million guaranteed and $40 million performance based, or did he just sign a contract for $50 million? How likely is it that he'll get the $50 million, right? And so the boards sort of look at that and say, look, he signed a contract for $50 million. Absent any sort of major injuries, which are unlikely, right, relatively speaking, you need to recognize that based on historic performance. And so you look at, how does my customer generally behave? What can I generally collect from the customer? And you got to recognize it as soon as you believe you've actually performed. Okay? So less conservative than what we know under the old rules. It's more aggressive, but the flip side is you're basically showing, I guess, more true to the actual transaction. Anything, any company, any industry is impacted by this. I said that earlier, but I've listed the ones that are probably more significant as far as impact, right? I do talk to manufacturers or service providers, not a huge impact there. But as far as like these industries, I mean, it could definitely have an impact. And so the overarching idea is if you have a long-term contract that sort of, you know, has multiple years of transactions, and in that contract you're doing more than just a one singular product or service, and it's also being delivered at different times or whenever it's needed, so it's not necessarily every month the same thing, that's when you get into issues with this type of stuff. And
Why automotive? That seems like a silly use.
yeah, so automotive, for multiple reasons. One, I said it's software on wheels, right? And so increasingly so, you're not just buying a vehicle, but there's a lot of other things you get with it. Now you can argue that whatever the software is and the functionality, it might not be significant as far as the total purchase price of a vehicle. Why it's on here, it's really service type warranties. So if you look at buying, say, BMW, you might get free service for 4 years, and it includes everything, right? And they sort of expand that. Under the old rules, they looked at that and say, hey, I'm just booking an accrual when I sell the vehicle for all the cost that I think I'm going to incur to basically perform under that service warranty. So Ford would book it, or BMW would book it, book the sale, and then book a cost accrual to say, hey, this is what I anticipate based on historic experience with that type of vehicle. The new rules say, no, you sold two things. This is interesting. You sold two things. You sold a car and you sold a service warranty, because they could go out and get that somewhere else, technically speaking. They could say, I just want the car without the service warranty and I got a separate warranty. Also, they could extend it after 4 years. A customer can say, I need another 4 years. So then it becomes a separate deliverable, and what the automotives are now going to have to deal with is essentially recognizing for two transactions, and as a result, if you bought a $40,000 car, they're going to have to recognize $35,000 at the time of sale. When you get the keys, you drive off. And the $5,000 ascribed to the service warranty is going to have to be recognized over the 4-year period. So it's a deferral of revenue, which changes the whole, you know, way of reporting and sort of how we look at companies that are in that industry. So we got an extra year, and these are the effective dates. And some people might walk out right now. It's like, I got to go to Starbucks and get me something, or I got to go back to work, because this looks like it's ways out. Okay? But if you're a public company and your calendar year, 2018, is the first year where you have to adopt it for your 2018 financial statements. That's 3 years away, but think about it. You've got a current year, 2018, in your 10K, and then 17 and 16 as comparatives, and 16 is around the corner. And you may have long-term contracts. So if you sign a contract today, it might still be effective in 16, and that contract might need to be accounted for differently under these new rules. So does it make sense to maybe start thinking about this? And this is the reason I'm talking to you or anyone else about this today. Public companies get an extra year, so they can adopt in 2019, but then still the first year that you're going to be impacted is going to be 2017, and if you don't have enough resources internally, you really don't want to be in a situation where it's like you give somebody a call and say, oh, I just was looking at my financial statements and my auditor says in 2019, hey, have you looked at this new revenue standard that's applicable this year? And it's like an oh shit moment, because you've got 1,000 contracts and they're like 3 to 4 years in length and they're complicated. So the reason I'm bringing it up now is because if you start early, I have a life too. I'd like to get home on time. Let's look at it now and then figure out what you need resource-wise, and so allow yourself some more time to plan for it.
So can you elect to go to the new standard early?
Yes. Yeah, so what they've done is they have said, we'll give you an extra year, but if you're ready, go ahead with the original effective date, which means public companies could apply it in 2017. And so maybe like a Microsoft or an IBM, I presume that they have started something already that they say, you know what, if we need the extra year, we'll do it, but we're going to show that we're the best in class and we're going to just show everybody how it's done. I think the other thing that might be interesting is IFRS generally allows early adoption, just in general. I'm not quite sure if they actually set any time from now onward. That happens. IFRS always says early adoption because they're trying to promote it globally. So if you like it enough, go ahead. I just don't see anybody really early adopting this even earlier than the date the FASB threw
So I'm
out.
just thinking as analysts then are going to be trying to understand revenue. In this,
Yeah.
in this, they're going to have one heck of a time trying to figure out who's adopted, who hasn't.
Absolutely. Yes, you're absolutely right. And actually they threw in another one. There's two models you can choose between as far as adoption is concerned. So analysts are going to have trouble figuring it out, which again, that's why investor relations need to be brought to the table early on so they can educate themselves on how it's going to work. And you basically have to quantify this to help everybody with, okay, now I get it. But here's the thing, when you adopt a new standard and it impacts the P&L, you're going to have a retained earnings impact as of the first date in your financial statements, right? So if you have a contract, this is the weird thing that could happen. There could be a contract for which you've recognized revenue in the past, but there's still something that should actually have been delivered according to the new rules before the opening balance sheet date, which is 1/1/16 if you're talking public and you're doing an 18 adoption. Then we're looking at recognizing that in retained earnings. So, and that then will never be put in the P&L, right? So you're catching up through retained earnings. So you've got revenue that just doesn't show up in your new financial statements. There could even be revenue recognized twice as a result. In the old period and in the new period, the same revenue shows up. So it's a lot of noise there in the year of adoption.
So the public company is clear about the implementation. The larger private companies, let's say the Coke industry, things like that,
Yeah.
clear. But really, almost any company that has a financial obligation to a lender to deliver GAAP audited financial
That's right.
business issue, and those companies that might have a financial covenant structure
Yeah.
based upon historic.
Absolutely.
Needs to have a dialogue with your bank about, hey, we've got these things coming in, we're going to have to adjust these measures to accommodate the fact that new GAAP
You're right.
doesn't reflect the old GAAP.
Yep.
We've got to change the ratio structure.
Yeah. No, it's an excellent point. And a lot of my clients look at stuff like that because the lease accounting is also proposed to change, and that's a way more controversial topic, and so they've actually not touched it for the last couple of years. But that changes EBITDA, obviously, when everything becomes a capital lease, which is what they propose. But the point is, you can look at your bank and you sign a new debt agreement, and the question is, as far as covenants, do you put in, I'll measure my covenants compliance based on old GAAP. So you basically freeze GAAP in your agreement. That's fine, right? Because you don't want the noise from a new accounting standard, but then that creates an obligation to keep tracking things based on old GAAP. So now you've got dual GAAP reporting within your company.
And I think HA&W will help go in and analyze what the difference
For sure.
between the old GAAP and
For sure. Yeah.
help you with the dialogue with the lender.
Yes. You want to co-present the next one? I mean, I like it.
Yeah, so you talked telecom before?
Yes.
Buying the phone and service?
Yeah.
So what happens, because this is really an industry where the customer can change the service plan on the go,
Yeah.
like on call,
Yeah.
internet. So what happens
Yeah.
in these,
Yeah, and you could have month to month. Like Cox is a client, and some of them are month to month.
does the telecom company has to change things on the back end?
Yes. So basically, even if you don't have a written contract where it's month to month, for example, or the customer says, you know what, halfway through, I'm basically going to add more services or take services off and be completely flexible, the company will be required to sort of look at historic experience and basically say, hey, a customer on average will give us 2 years of revenue in X amount. And so that's how they look at a contract and basically recognize revenue based on your expectations. I think the point is when a contract changes and you didn't anticipate it, but it has an impact that goes back to the original date, you have to catch up. And some of that stuff might go through retained earnings if you haven't recognized that, or is it not reflected in the P&L in the current year. So there's a catch-up requirement on some of this stuff. Go ahead.
Ramon, you may not know the answer to this yet, but so, you know, one of the big red flags under GAAP is to suddenly change the way you're doing your
For sure.
recognition.
Yeah.
Do you know, as part of this, because it is going to be difficult to
Yeah.
transition, are they going to maybe allow companies to go, okay, I'm just going to go ahead and recognize all the revenue of my existing contracts
Yeah.
and start fresh from this point forward? Do you know if you have any insight into whether they're going to allow companies to do that?
Well, if you're really strategic about it and you have the flexibility with your customers to sort of agree on something and say, hey, old contract, let's, you know, work together to make sure I deliver everything to you before the effective date, and the customer accepts it, so you've got a real, like, fair value based at arm's length transaction, I wouldn't see there would be a problem with that. Actually, I think it makes sense. And I sat down with a software company the other day, and they had the sales force in the meeting, because you need to get the sales guys on board with this, because they historically were feeling restricted from delivering certain things and promising certain things. And now it's like, well, if you can measure the actual fair value of what you're promising, and you used to have this concept called VSOE in software world, which means vendor specific objective evidence. It's some crazy accounting geek that came up with it, but it's fair value based. So you actually, when you deliver something, you have to have some type of objective measure of what the fair value is of it. And then you got to do like a bell curve analysis internally to figure out what sort of like the average price. And it's crazy, right? That goes out the door now, and they say, look, if you don't know the fair value of something, what you do is you do a cost plus a reasonable margin measurement. So now that sounds easy, but the software I was talking to companies, they said, look, we don't track the cost of everything that we deliver. So this is the reason why you got to start early. Now I have to implement a policy to track the cost, otherwise I can't recognize it early and I have to wait again. I'm going to say, look, you know, engineers, programmers, track your hours for the specific deliverable, then I can measure the cost. I'll put on a 15 to 20% margin based on, you know, my estimation, and then you got the way to recognize it. So, but I think all of this, and a lot of it, could have strategic impacts, and I think it makes sense to plan early and then figure out what's the best for the company. Obviously, the less noise, the better. The better my investors understand what I'm doing, the better. My clients, customers, if my sales force is now allowed to promise things that they might like, it obviously could even be used from a commercial perspective. It's weird, accounting shouldn't really drive the business, but in this particular area, it clearly does. Hence the reason why it took so long for the boards to come out with it.
So does this replace GAAP? Does this imply GAAP is maybe in the second?
Replace GAAP? Yeah, the old US GAAP goes. Yeah. Yeah, so it's now they refer to them as ASC standards. Used to be FAS something rather, right? But now it used to be ASC 605 was the old one for revenue, and it's still applicable today. But when this is effective, it's going to be ASC 606.
But that's just on the revenue side, right?
Yes. Yeah. Just revenue. There's another component. I'll tell you, I need to check on time, but when do I have?
10 more minutes.
10 more minutes. Okay, thanks, Narcy. So this one illustrates you can have, and again, reason to start early thinking about it and quantifying the impact, because and the effort required to restate. There's two methods. The one that's full retro is obviously the easiest one to understand, and it's what I just explained. If 2018 is when I have to adopt, I got to restate all my comparative years, and I got 1/116 if I'm a calendar year company to restate, right? And then it goes through retained earnings, and from that date onward, I'm accounting for all the contracts under the new rules. There's a modified retro, and this one's highly controversial. It's sort of complicated in a way, but it basically says my year of adoption is 2018, so my opening balance sheet date becomes 1/118, and I'm leaving my comparative periods untouched. And so it sounds easier, but they've also required, which is interesting, but they said, look, you can do that, but I still would like to know the impact on your comparative years. You don't have to book them, but put them in disclosures. Like, I still have to do the same amount of work, right? Disclosures don't have the same prominence. So you might say, look, I'm taking a broad brush and I'm going to just, throw out a number. You can look at it that way. I just think from a pure accounting perspective, I think the full retro has a preference because it's sort of clean and it's clear. The modified retro, just threw it in there to get companies to just sort of stop complaining about the pervasiveness of this and give them sort of an out in trying to do as much as possible. But at the end of the day, it's still going to require almost the same amount of work, in my opinion.
Ramon, the thing that's interesting about that is that companies are going to adopt both methods.
Yeah.
So therefore, comparing companies is going to be very difficult.
Yeah, that you're going to have. The boards have acknowledged that, but they said, look, there's going to be some noise in the year of adoption. We're just going to live with it, right?
What would you just kind of estimate the range of the noise to be? 10% to 30%, or in terms of bottom line numbers, or in terms, what would the noise be that you have to think?
Well, I guess the noise technically could be, if I'm Microsoft, I'm doing full retro, right? And I'm IBM and I'm doing modified retro. Now I've got two sets of financials. The one only has 1 year in accordance with the new rule, and the other has 3 years. So I can look at the 3 years in the Microsoft one and have sort of comparable years in one set of books. And the other one, I really hardly could ever figure out. I guess with disclosures, I can kind of see where it would fall out. So it makes it harder for a reader of the financials to get to some comparability.
Does that affect the analysts?
Yeah, I would think so. Analysts, they typically have their own little model, right? And they do some add backs and all kinds of stuff. I think they would be highly interested in it. I think I have it to do basically to do a little bit of specific research as far as like talking to some of the analysts to see how they feel about this. But there have been reach outs by the board where they said, hey, what do you guys prefer? And get your point of view across. And I can't help but think that analysts are going to be highly focused on this.
They have seeds of doubt, don't go low.
What's that?
They have seeds of doubt, just because it's hard to figure out.
Yeah, for sure.
And they'll go low.
Yeah.
And end up hurting your stock price.
Yeah, for sure. Look, materiality is always a factor, right? And so the real question is, you can't just like blow by this thing and say, look, it's not going to impact us that much. You'd have to do some work. Of course, the industries I've listed will have an impact, but it's not going to be, I've got a $100 million contract and I used to recognize, 5 times $20 million each year. It's a 5-year contract. And all of a sudden now it's going to be drastically different. It could be that I've just identified an additional deliverable in that contract. And now I have to recognize in month number 1, 30 million instead of 20 million. I sort of see how things the pattern changes somewhat, but it's not going to be a real drastic change as it relates to that contract. It's more of a fine tuning and identifying more units of account, more deliverables to recognize, and therefore more allocation to those particular deliverables. And in a general sense, we expect revenue recognition to be more aggressive. So you'll pull the 100 million, a part of that, more forward. And so, and when you adopt, a lot of that might go into retained earnings. So the first year that you show under the new rules will have a relatively low revenue number. Then an analyst might say, well, really, technically under the old rules, that would have been recognized in that year. So they may have to do an add back for their models.
Seems like it's going to complicate M&A also because.
For sure.
Yeah.
Yeah.
Take that because you got usually.
Yeah.
Your revenue plus some multiple earnings.
Yes. Yeah, your cash flow projections, valuations. Tax is another one. Tax generally follows book, right? So now you have to think about a method election. Do you want to do this? And since it's more aggressive on GAAP, do you want to follow with tax? I mean, you'll end up maybe paying more tax as a result or earlier in the year of adoption. So those are things everybody needs to be at the table. Technology, and I'll show you, it's a very simple model. I won't bore you with the details, but it generally says, look, I got a contract. What's in it? When do I deliver? How do I allocate? And then I'm going to recognize the revenue. One thing to keep in mind, for those of us that know SAB 104, SAB 101, you always have these 4 criteria you have to meet before you can recognize. It's gone. Now they just say, I recognize when control transfers to my customer, and control is defined as the customer has a benefit from using the product or the service. So this is the principle-based type of world. It's like, okay, so now I'm going to define as a company when my customer has control. When do they have control? And if it's software or a service, it's harder to figure that out, of course. When can they use it?
Ship, receive, download, right? I mean,
You're right. Well, you could even say they got it, they have access to it, but they haven't used it yet, but that's not my problem. They got the benefit. On the day that they actually start, using that, which I could probably see, but I've made it available to them. So I think there's an argument to say at that point in time I can recognize. Yeah.
so I've come out of the software industry. so
Right.
I'm here, and thank you for making this interesting.
You're welcome. Thank you for the compliment.
So look out 5 years, forget the transition, all
Right.
those headaches, look out 5 years. Is it gonna be easier on the companies to account under the new plan than?
Yes.
it was? Okay.
Yes. Hard now because we have to sort of define how we're going to do things. And I think people talk to each other more. It's like, how are you doing this? How are you doing that? I think overall it's easier for sure. And it's also going to just sort of, erode this like revenue recognition specialist role, which, now I know I've talked to some of these bigger companies in Atlanta and they're looking for a revenue director. Hard to find. They got to go outside of market to get them. And it's a software person they need. So it's either, generally it's West Coast, right? And so bringing somebody in, it's going to be a pricey person for a manager, director, or senior manager role. I think over time that, of course, you want an industry expertise person, but it's not necessarily a SOP 97.2 expert anymore, right? It's going to be, well, I've applied it here, and so it's more gray.
With respect to construction, does that mean moving from percentage of completion to more completed contract?
Yeah, so construction companies are funny, right? In a way, with accounting. When the standard first came out, there were 900 comment letters to the FASB, and so it was flooded, right? 200 of those were from construction companies, and it was surprising because I was like, well, the softwares are going to be all over this, right? No, it was construction companies, and they bonded together and had associations, and they said, what are you doing? Like, our standard is 81.1. We've known it for years, percentage of completion, because they were afraid that when they look at a project, let's say it's a building or a bridge, they were afraid that the boards were going to make them sort of look at a project in components and say, hey, I've delivered excavation, I've delivered foundation, I've delivered HVAC, electrical, roof, and I have to break all those parts up and then recognize as I build them, as opposed to just the building over time. And because of that pressure, the boards have actually modified the standard a little bit to make it easier. But again, even for those guys, it makes sense to start sort of analyzing this. They might be able to continue down the path that they have in the past. But the auditor's going to expect something more than just, hey, you know, overall, I think we can fit in here. There are also some sleeper issues in the standard that need to be addressed. One of them is contract acquisition costs. So if you have a sales force and they're trying to close on contracts, they get paid a sales commission. You generally speaking flow that through to P&L as incurred. This new standard says you have to capitalize the sales commission, and if you have closed on a 5-year contract, you amortize that sales commission over the 5-year contract. Time value of money, discounting cash flows, if you will, is also a requirement. So if I sign up with a 5-year contract, my payments are sort of off from when I complete delivery, and there's more than a year in between. You actually have to either calculate interest expense or even interest income, where you actually recognize more revenue than what you got paid based on when the payments happen compared to the delivery. Those are two things that are sort of annoying in a way, but they require more work, and therefore technology should be considered. Like Excel might not really be sufficient. So I think I've covered the meat of it. And hopefully I didn't ruin your weekend, or I'm here if you want to talk. You can call me. I think, like I said, I mean, at the end of the day, we still have a lot of time, and there's a lot of time to prepare. So if you start early, it shouldn't really disrupt you that much. And so that would be my advice.
I come from a very small company thing, so I have a very cynical attitude towards these analysts.
Sure.
They don't do thorough analysis.
Right.
They're on like a herd.
Right.
So I need to run faster than the tiger.
You gotta be two steps
I
ahead.
run faster than the tiger, and only the other analysts I need to beat them. So it's going to be a momentum play for the next 3 years.
Sure.
While the dust settles.
Yeah.
Everybody is trying to see how others are doing.
Yeah.
Am I doing better than them?
Yeah.
That kind of a mentality.
Yeah.
rather than doing a thorough.
Yeah, and that makes sense. I think if you consider potentially the need for some application to help you with some of this, depending on how complicated it is for you, an IT implementation for those of us that have gone through them could take anywhere between 6 months to a year or whatever, and they always say that before you sign the contract, and then it always takes longer than what they said, right? So now we're dealing with something that governs revenue, and it could be complicated. There's a couple of boutique vendors like Softrax, RefPro, RefStream. They all do this stuff. Not entirely certain if they do it the way the new standard requires it. They say they do, but a lot of it is in customization. So it's like, oh, how do you want to deal with it? Well, how does it work for you? And so if you add in some time to figure out some kind of technology solution, then it becomes more relevant to start early, is what I would say. And you might go through an assessment and say, Excel works fine, and that's fine. I mean, if your auditor's happy with that, then, or you built something within your ERP system, or there's multiple avenues, of course.
How much additional revenue is this going to bump for accounting firms?
Well,
They call it SOX as no content left behind.
Well, so yeah. I mean, I was in year 1 of SOX at Eastman Chemical, and I can't say too much about it, but we actually sort of got punished for, doing way too much in year 1 when they came out with AS5. I think you got to look at it this way. For consultants and accounting advisors, there's not that many that actually do this type of stuff. And even in the Southeast or Atlanta, I know I run into the same people all the time. I think they obviously could benefit from it in that, there'll be a good, decent, paycheck coming from that. I think as far as the auditors are concerned, and that's generally what I do, is to anticipate what the auditor wants and help a company get ready for it. Again, the starting early concept, don't talk to your auditor yet. Say, hey, I've seen it. I'm looking at it, I'm assessing it, and I think the best thing to do is, yes, you can get their point of view, but there's a lot of possibility within the broad principles. Get your position documented, either on your own or with help from somebody else, and put a well-documented rationale in front of your auditor and let them review it, because if it's all within the spirit of the guidance, they'd have a hard time telling you did it wrong. But again, that's another thing. You have to have a position within something that's this broad. If you start having like a verbal with them and go back and forth on stuff, it's going to be way inefficient, and you're going to see that in your bill. So, yeah. Well, thanks.